the IRS is very secretive in terms of who it is that it selects in order to audit that individual's tax returns. Now, because they are so secretive about it, that leaves a lot of room for myths to emerge to fill the gaps so people feel better about, hey, this is kind of what is happening. So it helps them be able to process the likelihood of being audited. Now, I'll tell you right now, the likelihood that you're going to be audited is very low. The IRS doesn't have the resources to audit very many returns every year, so percentage-wise, it's pretty low. But understanding that is only part of the issue. It's still a lot of uncertainty associated with it. So I'm a tax attorney and tax professor, and what I'm going to do is I'm going to walk you through the process, and I'm going to talk about some of these myths that exist, and I'm going to explain what actually occurs as it relates to those myths as to whether there's any truth associated with that myth or not. So I'll break this into 3 different components based upon the type of myth that it is. Okay, so let's go ahead and get started on these myths. Okay, our first set of myths that we're looking at are based upon filing. So these are issues dealing with filing, and these myths have emerged. So the first one is, hey, the timing's going to make a difference. So you might hear something like filing early or late is going to result in an audit. That's just not true. The timing's not going to actually impact it. So the IRS isn't worried about the timing of your filing. What it's worried about is the content inside your filing. So whether you file on February 1st or even late January, or you're going to be filing on April 15th and you're waiting till that last minute, you know what? Your audit risk is still going to be the same. Again, it's looking at the content, not the filing date, so you don't have an increased level of risk if you're filing early in the season or later in the season. So that's the first myth. The second myth is using tax software or e-filing increases the risk. And again, that doesn't matter. The filing method does not matter. As a matter of fact, almost all returns today are processed and submitted electronically. So most of them are going to be done electronically. And if you file electronically, it often reduces errors, especially as it relates to math errors and those types of things. So even before it's going to be accepted, a lot of those things are caught. So if anything, it could reduce your your audit risk a bit because it is catching some of those early types of errors or reducing those types of errors for you. The third one, and as it relates to our filing statuses and filing in general, is going to be an amended return automatically leads to an audit. So you have to file an amended return. Now, it doesn't automatically lead to an audit. What will happen is amended returns are often reviewed, especially if you file an amended return and now all of a sudden you're claiming a large deduction or a large refund, I should say. That's going to be something that's going to be reviewed. But look at, most of them aren't going to be audited. So that is just a myth that an amended return is going to automatically mean that you're going to be audited. So what you want to do if you are doing an amended return, just make sure you have clear explanations, and it's going to reduce the review of an audit risk. So just be accurate on what you're saying, and you're not going to have that audit. At least it's not going to be automatically audited. Okay, let's go ahead and look at our next set. Okay, our next myth that we're looking at, and all of these are going to be dealing with deductions and credits. So we've gone from filing to deductions and credits. Now with these deductions and credits, the myths are taking the standard deduction is suspicious. That is just absolutely not true. As a matter of fact, taking the standard deduction helps minimize risk, if anything, because you're taking what Congress gave you, the standard deduction. There's not really much to audit based on the standard deduction, especially if you're claiming the correct filing status. Most taxpayers today take the standard deduction, so most of them aren't even going to be taking itemized deductions. So it's not a red flag. Where you start seeing more of a red flag would be if you're itemizing your deductions and you're claiming an extremely large amount of itemized deductions. The IRS may say, whoa, based on your income, now you have all these itemized deductions. That could cause an issue for an audit, but not because you're taking the standard deduction. All right, the next one is a large charitable donation always triggers an audit. No, it doesn't always trigger an audit. So what the IRS will look at is this is something that's unusual, or if you don't have any documentation, so you have a large deduction and it doesn't have the documentation, now that can trigger an audit. So what you're going to want to do is keep the receipts. Make sure you have your records as you're going through here. So if you are audited, you're going to be able to claim that. But keep those records that you have, and you're going to be okay on those as long as they're legit charitable donations. The third one is going to be home office deductions guarantee an audit. All right, no, you're not guaranteed to be audited if you're taking a home office. And as a matter of fact, there's a couple different ways that you do deductions for your home office. There's going to be one based upon the square footage of your house, and you're going to be able to take X amount of deductions. The other one's going to be based on your actual use. So, if you're using something for a home office, if you have an office, it's a home office, it has to be used exclusively and regularly for the deduction to apply. But if you qualify for the home office deduction, then yes, you can take that home office deduction. It doesn't automatically mean that you're going to be audited. So don't think that there's an automatic audit based upon a home office deduction. But do keep your records. Make sure that you're qualifying. I have a full video that talks about home office deductions if you're interested in learning whether you qualify in the technical aspects of the deduction. So that would be where you'd want to go to. But just know that a home office deduction will not automatically guarantee that you're going to be audited. All right, now let's go to our final set. Okay, so our final set here is going to be on just miss overall. And what you're looking at is a lot of individuals think, listen, only high individual taxpayers are going to be audited, and that's just not accurate. Now, there is a tendency for the IRS to audit high net worth individuals, oftentimes because they have a more complicated return, but it is also common for individuals who don't have as much income, that aren't high income taxpayers, to be audited, particularly if they're claiming certain types of credits. So one of the areas of the IRS has put as an emphasis to curb abuse is the earned income tax credit. So an individual who's making $25,000 and claiming the earned income tax credit, they also have a decent likelihood of being audited. Now, when I say decent likelihood, I do want to clarify, your overall likelihood of being audited is still going to be extremely low, but there are certain areas that can increase that slightly, and one would be the earned income tax credit. And then, of course, high income individuals, that also does it. So just because you're not a high income individual doesn't mean you're not going to be audited. The second one is that if you have a math error, you're going to be audited. And that, again, is not correct. What will happen is you'll usually receive a notice from the IRS, and they're going to correct the math error. So that's what usually happens. It doesn't trigger an entire audit when you have that math error in most cases. And then the third one is going to be the round numbers look better to the IRS. No, that's just not true. Use your actual numbers when you can. So use the actual numbers you have. Because if you're doing round numbers, then what the IRS starts to look at, or what their systems are saying is, hey, you know what, maybe this was just estimated and these aren't their actual costs, and that could, or these actual expenses, and that could actually result in more likelihood of an audit. So having round numbers does not look better to the IRS. Use your actual numbers and make it easier on yourself. All right, those are your tax myths that are out there. There are many, many more than that, but these are some of the more common ones that I wanted to go ahead and make sure that we addressed. Hey, if these videos are helpful, go ahead and subscribe to this channel. Also, what I will do is an actual video on what the IRS looks at when they are selecting a person to be audited. So how does the IRS determine whether they're going to audit you or not? So subscribe and look for that video. All right, thanks for watching.